This set of slides discusses the investment policy statement. The investment policy statement, or the IPS, is a client-specific summation of the circumstances, objectives, constraints, and policies that govern the relationship between advisor and investor. A well-constructed IPS presents the investor's financial objectives, the degree of risk they are willing to take, and any relevant investment constraints that the advisor must consider. It also sets operational guidelines for constructing a portfolio that can be expected to best meet these objectives while remaining in compliance with any constraints. Finally, the IPS establishes a mutually agreed upon basis for portfolio monitoring and review. Why? So constructing an IPS is a dynamic process in which an individual and his investment advisor must identify and then reconcile investment objectives, portfolio constraints, and risk tolerance. The process gives the investor great control over their financial destiny, as it is an educational process. It is also portable and easily understood by other advisors. It also serves as a document of understanding that protects the advisor and the individual investor. So there are some key steps to setting up the investment policy statement, and setting return and risk objectives is extremely important. So here we're going to discuss the return objective. So the return requirement is a return level necessary to achieve the investor's primary or critical long-term financial objectives. The return desire is the return level associated with the investor's secondary goals. Return requirements are driven by annual spending and relatively long-term savings goals. When an investor's current spending and long-term savings goals are expressed in terms of purchasing power, however, it becomes clear that even income-oriented portfolios require a considerable element of nominal growth, instead of matching income goals with income assets and growth goals with growth assets. So it's recommended that you use a total return approach. That is to look at the individual's investment goals and then identify the after-tax portfolio return necessary to meet those goals. That requirement must then be reconciled with the individual's separately determined risk tolerance and investment constraints. If return objectives are inconsistent with risk tolerance, the investor needs to consider adjusting the return objective, adjusting their risk tolerance, deferring retirement, increasing savings, and reducing expenses, etc. A cash flow analysis, particularly a 5-year cash flow statement, can help to calculate the required return and to fully understand the cumulative effects of anticipated changes in income, living expenses, and in various stages of life events of the financial objectives. i.e., if you were to buy an investment property in year 1, what are the ongoing expenses and incomes attributed to that property, and how does that impact on your other decisions within your portfolio? Okay, so setting the risk objective. So the risk objective is a function of both ability to take risk and willingness to take risk. The ability to take risk assessment is suitable to quantitative measurement. Approaches vary, but all address the same following questions. So the first one is, what are investors' financial needs and goals, both long-term and short-term? So an investor's ability to take risk is determined by his financial goals relative to resources and the time frame within which these goals must be met. The second question is, how important are these goals? How serious are the consequences if they are not met? So critical goals allow lower margin for error and reduce the portfolio's ability to accommodate volatile investments. Financial security and the ability to maintain current lifestyle are generally among the investor's highest priorities. Luxury spending is least critical. Luxury spending is least critical. And the third one is, how large an investment shortfall can the investor's portfolio bear before jeopardizing its ability to meet major short-term and long-term investment goals? The limit of a portfolio's ability to accept risk is reached when the probability of failing to meet a high priority objective becomes unacceptably high. The investment advisor can provide guidance with probability estimates and identify clearly unrealistic expectations, but the ultimate determination of acceptable will depend on the investor's general willingness to accept risk. And willingness to take risk is a more subjective assessment. Willingness may not remain constant through time. Another key component of the investment policy statement is identifying constraints. So it should identify all economic and operational constraints on the investment portfolio. They generally fall into 5 categories: liquidity, time horizon, taxes, legal and regulatory environment, and unique circumstances. So liquidity, as you know, is the ability to convert assets to cash at a fair price. Transaction costs can affect an asset's liquidity, and a volatile market can also impact on an asset's liquidity. So significant liquidity requirements constrain the investor's ability to bear risk. Liquidity requirements may arise because of ongoing expenses, so they have predictable ongoing costs of daily living that they need to account for and keep cash for. They might need emergency reserves, so individuals in cyclical or litigious environments might require a larger reserve than those in more stable settings, because the timing is uncertain, but the need would be imminent. And negative liquidity events, so major changes in ongoing expenses like maybe a divorce, a home repair, or retirement that was unforeseen, or an illness may mean that investors borrow to be able to meet their ongoing daily living costs. So it's a negative liquidity event. And it's recommended that the IPS contains a statement about the role of illiquid assets in the portfolio, i.e. assets that can't be sold easily. And that might be like the family home. Is that included in your tradable assets, or is that a separate asset? Because it's your family home and you're emotionally attached to it. There might also be other limitations like limited partnerships, common stock with trading restrictions, or assets burdened by pending litigation owned by your business, etc. Time horizon. So generally we regard long term as 15 years to 20 years. We regard short term as less than 3 years, and in between 3 to 15 years, it's sort of a transition from intermediate to long term. The investor might be in multi-stage time horizon rather than a single time horizon. For example, an elderly couple or elderly person may plan for grandchildren. So they may be looking at the grandchildren's stage of life as well in their asset management plan. And it's the grandchildren's personal circumstances that determine the investment portfolio's goals and the time horizon. So that's multi-stage time horizon. Taxes are not surprisingly the most complex constraint. They pose a significant challenge to wealth accumulation and the transfer of wealth, and they vary across regions and continents. There are a few different types of managing the tax constraint. One is to look at tax deferrals. So taxes may be charged annually, affecting the amount to be reinvested annually and reduce the compounding effect, or taxes may be deferred and deducted at the end, i.e. upon the sale of the asset. For the long-term investor, tax strategies that seek to defer taxes and maximize the time during which investment returns can be reinvested maximize compounding effects. There's also loss harvesting, which focuses on realizing capital losses to offset otherwise taxable gains without impairing investment performance. There's tax avoidance, which is where you avoid taxes where legally possible. Tax advantage investments usually come at a price. They offer low returns, they're higher expenses, reduce liquidity, and have specified holding periods. Or you could pursue tax reduction, which is when income rates exceed capital gains tax rates. So the portfolio can then be tilted towards low dividend paying stock. Because capital gains tax is assessed at the sale of the asset, it is deferred tax as well as a lower rate. And wealth transfer focuses on either the timing or the legal structure of the transfer. And the legal and regulatory environment involve taxation and transfer of personal property ownership. Whatever a portfolio manager's level of legal and regulatory understanding, you must be careful to avoid giving advice that would constitute the practice of law. So you might need to refer people to solicitors and lawyers regarding the legal and regulatory environment. There are some tools like trust foundations and gifting that are used to manage transfers of wealth and reducing tax liabilities. And unique circumstances are where such constraints might include guidelines for social or special purpose investment, assets legally restricted from sale, directed brokerage arrangements, and privacy concerns. So any other unique things particular to that investor.